So it's very clear. The Fed's going to cut in September. How much they're going to cut and how quickly after that they're going to cut is the question. How do you guys think about it?
Yeah, so I think, as you heard Mary Daly say, I think they have much more confidence in their path forward than they've had in the last few months. I think the big change for them is just they feel more confident about inflation. I think their eye is on the labor market now, but even the labor market dynamics are giving them comfort that the labor market has weakened. Our view is a little bit that it's the supply of labor coming into the marketplace rather than unemployment, which is, I think, giving them a higher confidence on the path forward. So clearly, September is in the books, and they just have to see how the August job report looks.
It's a little concerning, though, Kamal, right? Because it's going to be either 25 or 50. It's more likely to be 25, but it's a massive difference, especially for the first rate cut. How are you hedging for a potential 50 basis point cut?
So that's a great question. So I think this rate environment has not just us, but every global investor paying attention to the path forward. Our view remains that it is valuable. The 25 basis points is much more valuable to fixed income investors than equity investors. I think you need the rates to move by 50, 75 basis points for the equity and the real estate investors to really care about that move. Given how long portfolios are from a duration perspective, any rate cut is going to create value for the fixed income investor first, and that's how we think about it.
So we've had a nice little washout here in the summer months, right? What's working right now in this environment and in this market?
I would say quality has come back into vogue. We've had a few years of very, very strong momentum on the equity side, particularly with the tech names. But I think quality is really coming back. I would say the sweet spot of the marketplace seems to be also mid-caps, to some extent some smaller caps, but mid-cap really is an area where you see rotation happening and a lot of earnings getting more attention. So I would say that from a risk perspective is in vogue right now.
You're big real estate investors?
Yes, we are.
We're all waiting to see what the impact on real estate will be, right?
Yes.
From mortgages to new builds to everything else. How hurt was your REIT franchise, and what do you anticipate will happen between now and the end of the year if, there are indeed 4 cuts?
So REITs were depressed. They were much more depressed than we have seen.
They were very sad, yes. They cried a lot.
For many years. But if you look at year-to-date returns, almost all REITs, including office REITs, which were the most depressed, have rallied very, very quickly. I do think there's more to go on the REIT side. The area that we see most momentum on is, obviously, we are a big investor in data centers, but we also do hotels and industrials as well. I do think as the market evolves in REITs, I think the global REIT portfolio has still not corrected as much as we would like. I think partly because of what happened with rates in places like Hong Kong and Japan, in addition to the US. But I do think the housing side of REITs is probably going to react very, very well. Industrials and housing would be an area I would watch out for.
But this is where the 25 or 50 comes into play, right?
Yes.
If it's 25, that's a normalization, in which case, okay, that's probably good for REITs and it's good for small and mid-cap stocks. But if it's 50, that says to me we're in deeper trouble than we thought, and then that's not so great for SMID. Or maybe it's a little dicier when it comes to real estate. Is that fair, or am I off?
I think 50 basis points still is good for the markets. It's not, we've been at such high elevated levels of rate that a 50 basis point cut is not really going to be a signal of a damaged economy. It's really just creating more opportunity for debt investors to get back into the marketplace.
You said you're in hotels as well and around the world.
Yeah.
Obviously, there are some parts of the world that are hurting very badly, and we're getting more and more confirmation that China is one of those.
Yeah.
But even in the US, it's a mixed picture about the consumer. We're not quite sure how healthy the consumer is at the various levels. Can you tell us a little bit more about that?
So I think the biggest change in that sector has been supply is the bigger story than demand. I think across the world, and we've all seen this with how the consumer has behaved, an extremely strong consumer that has continued to spend. You've seen recently luxury and leisure take a back seat. You particularly heard it from the airlines and some of the other hospitality operators. But there is generally a dearth of supply of hotels across the world. And strategically, we are much more of a strategic investor. I do see in places like Europe, that is something where demand supply has been an imbalance for a while. In US and in Europe, I would say data centers, which is a big AI play, continues to be very, very strong in terms of pickup on cap rates, as well as how occupancy or use by a technology company scales up.
So for your clients, what do you tell them about how to deal with AI in terms of how to invest at this point, if they weren't already invested?
Our view is you want to invest in the infrastructure of AI.
Okay.
And I think you've seen it with the hardware companies, but the real estate companies are a big participant in the build out of the infrastructure. And I think that is the way to play it in our view, because that is a very long tail cycle that will take a while.
So why did we see the siphoning off of NVIDIA in this market sell-off, right? So NVIDIA is still doing fine. It's doing better. And all of the other AI stocks seem to be selling off still.
Well, it's an amazing technology company, but it has had a lot of interest and a lot of momentum. And so longer term, it'll still do fine. But as I said, there are other sectors attached to AI that are catching up now. And I think you'll get to a balance in who participates in this growth cycle.
Then isn't there so much demand in that? I mean, I feel like I talk to every real estate guy, and they're like, data centers, yay. Yeah. So like, isn't that driving up valuations? I'm going to sort of squeeze then potential returns, or what?
There has been a lot of interest in the sector per se. We've done this for a long time, and I think our view remains that you need to be an astute real estate investor to really operate. Ultimately, it is real estate. It is not technology. And so you have to have been a long-term real estate investor. You know, our company's been in existence 145 years, so we've done real estate for a very, very long period of time, including GFC. One of our views is you have to understand how to manage the property. You will have to have an understanding of how you build these assets and how you maintain these assets. And there is a big element of getting the right power supply, managing water. So it's a more complicated real asset type than most people realize.